Jeff.
Hey, Meesha.
Welcome to another episode of North Atlanta Real Estate with Jeff and Meesha Rawal. Let's jump right in. Today we're going to talk about interest rates, and I will pose some questions to Jeff about what the interest rates are today and kind of compare them with historical data and maybe make future projections.
Yeah, that sounds like a good topic.
Fantastic. So we have four types of interest programs. And for a buyer, you have the VA for veterans, FHA for first-time home buyers, where you put 3.5% down, USDA, where you're buying outside the city limits, where it's 100% loan, and then the conventional loan, which is what is the most popular.
Yeah, right. Absolutely. That's what most people get. And so why don't we just, to keep things simple, why don't we do our examples with just a conventional loan today, right? Fixed rate, 30-year.
Fantastic. Okay. So if I was a home buyer and I was trying to buy a house for $500,000, and I come to you and I'm like, Jeff, what can I buy? How much is my monthly payment going to be?
Yeah, so that's a great question. So let's just figure that the rates are dependent upon obviously lots of factors, credit score, how much you're putting down, et cetera. Let's just assume right now we're talking about a 6.5% interest rate. That's about as good as it's going to get today in our market. So let's just use
July
that.
2025.
That's correct. So let's just use that for right now. And so if you had a $500,000 loan or a sales price and you're going to put 10% down, that would leave you then with a $450,000 loan and a payment of $2,844 a month, just principal and interest. So then I guess the question we get a lot is what happens if interest rates drop, right?
I mean, by let's say 0.5%.
Okay, so yeah, so if it dropped 0.5%, because
to 6%,
to 6%, because there are some economists that are saying, hey, the Fed's going to probably do 2 interest rate cuts of 1/4 point, even though it's not directly correlated. People are I guess forecasting that maybe our rates will drop to about 6% by the end of the year. So if that happened, that payment from it would drop from $2,844 down to $2,698, so saving you $146 a month.
Just in principal and interest.
Correct.
Now, in terms of home ownership is not only principal and interest. There are some other components to your monthly budget that you need to factor in.
Yeah, absolutely. And so you have property taxes, obviously.
And our property taxes in Fulton County, South Forsyth, are about?
Well, I think you got to figure that it's a little under like kind of 1% of the value of the home typically. And so if we had a $500,000 home, let's pretend it's going to be about $4,800 or $400 a month.
Perfect.
When you divide it by 12,
so you add
right?
that to $2,844 plus $400 as your taxes.
Yeah. And then what we have hazard insurance, like if your house, you got to protect it from fire, et cetera, right? The lender requires it.
So homeowners insurance.
And how much would that be roughly, would you say?
About $200.
Yeah, sounds about right.
So $2,400 a year.
Yeah.
And then because you're putting 10% down, we have something called the private mortgage insurance, which is a PMI.
Correct. Yeah.
And that's about $200. So you're looking at a monthly outlay of $3,644 to buy a house for $500,000 with 10% down.
And that's today at 6.5%. And then, if it dropped, to 6%, you're going to save $146 off of that, or now you're down to basically $3,500. So the other way to look at that is, if you kept your payment the same instead of dropping it by that $146, that gives you an extra $24,000 in purchasing power. You were making an observation though that I thought was really good the other day to me that, if interest rates drop, that the demand might pick up. And so talk a little bit about that. What might happen if that happened?
So if the interest rates drops to 6%, and let's say the house price jumps from $500,000 to $525,000, your monthly payment pretty much remains the same. So it's a wash. So you can either buy a house today at the higher interest rate at $500,000 or wait till tomorrow where the interest rate drops, but also simultaneously the house prices goes up.
And that's not a guarantee, of course, that the home prices go up, but it certainly wouldn't be surprising. They will fluctuate, and we know from doing a lot of our prospecting where we go by and visit people in neighborhoods that there are a lot of people that tell us they would love to buy a new home, but they're kind of trapped there. And what is this golden handcuff thing you talk about?
I know, that's this new term that's come up because a lot of homeowners have interest rates of sub 4%. And if they decide they want to sell and buy, they have to buy at the higher interest rate. So they are pretty much stuck. But they have equity.
Yeah.
And so that's where the golden comes in and the handcuffs come in, because you're stuck with the houses that you bought in 2020, maybe earlier, and then you refinanced, after 2020.
That's true, right? A lot of people just refinanced, and and we also kind of forget right now we still have pretty tight inventory for a buyer. We're at levels that maybe they've been increasing lately, and it feels like there's more homes on the market, and that is true, but we're still less than half of the amount of homes that we had on the market in 2019, pre-COVID days.
Absolutely, and if the interest rate drops to 5%,
Yeah.
I think we'll see a lot of homeowners put their houses on the market, because now they can afford to buy another house, and that's going to be great for buyers as well, because then they'll have a lot more houses to choose from.
Yeah, absolutely. Totally agree with you. Do you think it would be helpful to look backwards to give folks some perspective of what interest rates were like over the course of time?
You've been in the business since the 1980s. Historically, we are not at the highest in terms of interest rate, but the amount of money that a family puts out in terms of towards their monthly payment is about 50% of their salary, which is a lot.
That is a lot. It's very unaffordable now. Just for the quick, easy of it is, back in the early 80s, 30-year rates broke over 17%, almost hit 18% briefly. And then it fell, and by 1990, we were down to, roughly 10%, 9.5%. And then most of the 90s to 2000, we were bouncing around in the sevens, basically from 8 to just about 7% for that whole decade, roughly. And then from 2000 to 2010, and part of that, as we get to 2010, that was that big recession we had, and they did start, pushing rates down. Now rates were starting to be below 6% pretty regularly. Coming out of that recession in 2010, when it was starting to end in 2011, we were down below 5% now. And now this is the problem that we have, as kind of what we just talked about, is from the 2010 to 2020, we've been just spoiled by these rates that have been sort of hovering below 5%. And then, of course, got pushed down to those ultra low rates coming out of COVID, when the Federal Reserve was buying mortgage-backed securities and drove the rates down. And they're probably not going to do that again. So maybe one message is, right now we've been at worse, 6.5%. I can tell you that when I was working in the 90s, people would have loved that rate, right? And perspective-wise. And so probably you can't sit around and pine and wait for that 3%. It's not going to come back. But we might get some 5s at some point in the next few years. What our world will look at like then and what our economy is going to be doing, it's hard to say, right?
Absolutely, absolutely. And that was a great informative session, Jeff. And I think we should do another session on FHA loans and VA loans in the next episode.
Yeah, I think that'd be a great idea.
And that was Jeff Ahi and Meesha Rawal wrapping up our episode on interest rates in the Atlanta area.
All right, bye for now.
Bye.